Welcome to the deep dive. Today we're jumping into business accounting. We're using those chapters you shared from Frank Wood's Business Accounting 1.
That's right, a foundational text.
And our mission, really, is to cut through all the jargon. We want to equip you, the listener, with the core ideas and show you why this matters, why it's, the lifeblood of a business.
Exactly. This isn't about making you an overnight accountant.
No, definitely not.
It's about giving you a solid, practical grasp of how businesses track their money, figure out if they're succeeding, and, well, make smarter decisions based on that.
We're focusing on the logic, the why behind it all.
Precisely, the why. So it actually makes sense, not just a bunch of rules.
Okay, so let's start right at the beginning. What is accounting, fundamentally? It's got to be more than just adding numbers up.
Oh, much more. Think of it like this. Every time a business does something involving money, buys something, sells something, pays a bill that's a transaction, accounting first figures out the monetary value of that transaction.
Okay, putting a price tag on it?
Yeah. Then it organizes all that information systematically. And finally, it presents it in a way that helps people make useful decisions. Are we making money? Can we afford this? That kind of thing.
So it's like keeping score for the business. That makes sense.
It's a great analogy, yeah. And the good news, truly, is you don't need advanced calculus or anything.
Phew.
Basic arithmetic, adding, subtracting, multiplying, dividing, that's really all the math you need. The skill is in understanding the system, the rules of the game.
That is reassuring. Now, you mentioned rules. This whole system, it's been around a while, hasn't it?
It really has. I mean, the core principles we use today, they were largely laid out in a book published way back in 1494.
Wow, 1494, seriously.
Seriously. By an Italian monk and mathematician named Luca Pacioli, he described this system of double-entry bookkeeping.
Double entry. We'll get to that, I assume.
We will. But the amazing thing is that fundamental idea that every transaction has two sides, it's basically been the standard for over 500 years.
Incredible staying power. Okay, so if double entry is key, what's the absolute bedrock concept? I saw something called the accounting equation mentioned a lot.
Ah, yes, the accounting equation. That is absolutely central. It looks simple, but it underpins everything. It's capital equals assets minus liabilities. Okay, let's unpack that. Assets. That's all the valuable stuff a business owns.
Exactly. Assets are resources the business controls, things that are expected to bring some future economic benefit. So, yeah, physical things like buildings, machinery, vehicles, the goods they plan to sell, inventory.
Right.
But also things like money owed to the business by its customers. That's called accounts receivable, and of course the cash it has in the bank.
Okay, makes sense. And liabilities.
Yeah,
That's the flip side. What the business owes.
spot on. Liabilities are the business's obligations to outsiders. Debts, things like money owed to suppliers for goods they've already delivered, unpaid bills like electricity or rent, loans they've taken out. Okay, so assets is what you have, liabilities is what you owe, and if you subtract the liabilities from the assets, what's left is capital.
That's it. Capital represents the owner's stake, their claim on the business's assets. You'll also hear it called owner's equity or net worth.
Net worth, right.
It's essentially what would be left over for the owner if the business sold all its assets and paid off all its debts. It goes up if the owner puts more money in or if the business makes a profit.
And down if they take money out or there's a loss.
Precisely. Withdrawals or losses reduce capital.
So this equation, capital, assets, liabilities, it's constantly in motion, but it always has to balance. It gives you a snapshot of the company's financial position.
Exactly. It must always balance.
Yeah.
Every transaction affects this equation, but it keeps it in equilibrium. It tells you at any point in time what the business owns, what it owes, and what the owner's stake is.
Let's take an example. Say a small business buys a new delivery van for £20,000, paying cash. How does that hit the equation?
Okay, good one. The business's cash, an asset goes down by £20,000. But its vehicles, another asset, go up by £20,000. So one asset decreased, another asset increased by the same amount. Liabilities didn't change, capital didn't change. The equation stays balanced.
Ah, okay. So assets just shifted around. What if they bought it with a loan instead?
Right. If they took out a £20,000 loan, then assets, vehicles would still go up by £20,000. But this time, liabilities, the loan, would also go up by £20,000. Cash wouldn't be affected initially. Again, balanced. Assets up, liabilities up.
I see. It shows how the asset was financed. Okay, that equation is fundamental. Now, How do businesses actually track all the individual ins and outs that affect this? You mentioned double entry earlier.
Yes, double entry bookkeeping. This is the practical system for recording transactions. The core idea, as we hinted, is that every single transaction affects at least two accounts.
Two accounts, always.
At least two, yes. And it uses a system of debits and credits to record these effects.
Debits and credits, the words that often scare people.
They can seem intimidating, but they're just labels for the two sides of a transaction. Think of it like this. To keep the accounting equation balanced, every transaction has to have equal debit and credit entries.
Okay. So how do we know what's a debit and what's a credit? Are there rules?
There are rules, or maybe think of them as axioms. The book mentions two key ones to start. One, for every debit entry, there must be a corresponding credit entry. Two, for every credit entry, a corresponding debit entry.
Equal and opposite, sort of?
Kind of. And how they apply depends on the type of account. For example, increases in assets are typically recorded as debits. Increases in liabilities or capital are typically recorded as credits.
Okay, hold on. Increases in assets are debits. Increases in liabilities and capital are credits. What about decreases?
They're the opposite. A decrease in an asset is a credit. A decrease in a liability or capital is a debit.
Let's try that printer ink example again. Bought 100 pounds of ink for cash.
Right, so supplies, that's an asset increase. An increase in an asset is a debit. So you debit supplies 100 pounds. Cash, another asset, decreased. A decrease in an asset is a credit. So you credit cash 100 pounds.
Debit supplies 100 pounds. Credit cash 100 pounds. Equal debit and credit. It balances. I think I'm getting it.
You are. That's the fundamental mechanism.
But what about buying and selling the actual stuff the business exists to sell, like inventory?
Good question. We use specific accounts for that. When a business buys inventory it intends to resell, we usually debit an account called purchases. This tracks the cost of goods bought for resale.
Okay, debit purchases.
When they sell that inventory, we credit an account called sales or revenue. This tracks the income from selling the goods.
Credit sales. Why separate accounts? Why not just track the inventory asset directly?
We do track the inventory asset as well, but
Yeah.
keeping purchases and sales separate makes it much easier to calculate the profit later on. We need to know the total sales revenue and the total cost of the goods that were sold.
Okay. For-profit calculation. And the book stressed this point. Purchases and sales in accounting usually mean buying and selling inventory, not buying, say, a new computer for the office.
Exactly. Buying a computer increases an asset account, like office equipment or computer equipment. Selling an old company car isn't sales either. It's a disposal of an asset, probably involving the vehicle's account, and maybe recording a gain or loss on that disposal.
Right. Terminology matters here.
Yeah.
Okay, so we're recording all these debits and credits for every transaction. That must generate a lot of data. How does it get summarized into something useful?
That's where the financial statements come in. They take all that detailed transaction data from the accounts and condense it into standardized reports that tell the business's financial story.
The report cards, basically.
Pretty much. The two main ones we need to focus on are the statement of profit or loss and the statement of financial position.
Statement of profit or loss.
Yeah.
That sounds like it shows. Well, profit or loss used to be the income statement, yeah.
Yeah, you got it. It summarizes the company's revenues and expenses over a period of time, say a month, a quarter, or a year. It calculates whether the business actually made money during that period.
And how does it do that calculation? What are the steps?
It starts with the total sales revenue for the period. Then it subtracts the cost of goods sold, basically, what it costs the business to buy or produce the goods that it sold.
Sales minus cost of goods sold. That gives you.
Gross profit. It's the profit purely from buying and selling the goods or services.
Okay, gross profit. But there are other expenses, right? Like rent, salaries.
Exactly. So from the gross profit, you then subtract all the other operating expenses, rent, salaries, utilities, marketing, depreciation, all that stuff. You might also add any other income the business earned, like interest. The final result is the net profit or net loss.
Got it. Sales, less cost of sales, gives gross profit. Gross profit, less all other expenses, plus other income, gives net profit. That's the bottom line.
That's the bottom line for that period, yeah.
Okay, what about the other big one? Statement of financial position. That was the balance sheet.
Correct. The statement of financial position is different. It's not over a period. It's a snapshot at a specific point in time, like December 31st.
The snapshot of what?
A snapshot of the accounting equation, essentially. It lists the business's assets, its liabilities, and its capital on that specific day. It shows its financial condition at that moment.
And how is it typically laid out?
Usually, assets are listed on one side or the top half. They're often broken down into non-current assets, the long-term ones, like buildings, equipment.
Things lasting more than a year.
Generally, yes.
Hmm.
And current assets, short-term ones like cash, accounts receivable, inventory, things expected to be used or converted to cash within a year.
Okay. Assets, non-current and current. What's on the other side?
Liabilities and capital. Liabilities are also often split into current liabilities, debts due within a year, like accounts payable, short-term loans.
And non-current liabilities.
Exactly. Long-term debts, like mortgages or bonds payable over many years. And finally, the capital section shows the owner's equity, which includes their initial investment plus any accumulated profits or minus losses that haven't been withdrawn.
And crucially, because it's based on the accounting equation.
The total assets must always equal the total liabilities plus capital. It has to balance. That's why it used to be called the balance sheet.
Right. Now, these two statements, profit or loss and financial position, they must be linked somehow, right? They aren't totally separate reports.
Absolutely linked. The net profit or loss, calculated on the statement of profit or loss for the period, that figure directly impacts the capital section on the statement of financial position at the end of that period.
How so?
Well, if the business made a profit, that increases the owner's equity specifically, an account often called retained earnings within the capital section. If it made a loss, retained earnings decrease. So the performance shown on one statement feeds directly into the position shown on the other.
Ah, okay. The profit earned during the year adds to the owner's stake shown at the end of the year. That makes sense. Now, the book really hammers home the importance of presentation. Things like clear headings, dates, just general tidiness. Why such a focus on that? Seems a bit basic.
It might seem basic, but imagine getting a report with no date or no company name. It's useless, right? Or worse, misleading. The annoyed partner example in the text is spot-on clarity is essential for communication.
Yeah, you don't want to confuse the people reading it.
And tidiness links directly to accuracy. Sloppy work leads to mistakes. Small errors in arithmetic, misposted numbers. They can snowball and give a completely wrong picture of the business's health. The book's comparison to the savings bank manager.
Right, not knowing if you have 5 or 5,000 pounds because the records are messy, that could be disastrous.
Exactly. Examiners focus on neatness because it's a proxy for care, accuracy, and competence. They need to ensure future accountants produce reliable information. In the real world, errors cost money and damage trust. Even with software, the principle holds. Garbage in, garbage out, clear, careful work is vital.
Okay, point taken. Precision matters. Beyond the mechanics, though, there are underlying concepts or assumptions guiding accountants. The book mentions things like prudence and realization. What are they about?
These are really important guiding principles. Prudence, sometimes called conservatism, is about exercising caution when dealing with uncertainty. It generally means you shouldn't overstate assets or profits, and you should make adequate provision for potential losses.
So don't count your chickens before they hatch, basically.
That's a good way to put it. Recognize expenses and liabilities as soon as possible, but only recognize revenues and assets when you're pretty sure they'll happen. The text mentions a recent debate about reinforcing prudence, showing it's still actively considered.
Okay, caution. What about realization?
Realization deals with when you should formally record revenue. The general principle is that revenue is recognized when it's earned, and the amount is reasonably certain. Usually, this is when goods are delivered or services are rendered, regardless of when the cash actually changes hands.
So if you sell something on credit in December but don't get paid until January.
You'd typically record the revenue in December, when the sale was made and earned, not wait until the cash arrives in January. This relates to something called accrual accounting, which is the standard approach.
Right, matching the revenue to when it was earned, not just when cash flows. And the text also raised an interesting challenge. One set of financial statements has to serve lots of different users: banks, investors, managers, tax authorities.
Yes, and they all might want slightly different information or focus on different aspects. A banker lending money cares a lot about liabilities and cash flow. A potential buyer might focus more on long-term profitability and assets.
But they generally only get one set of accounts.
Usually, yes. General-purpose financial statements try to provide a common base of information that's useful to most users. It's a balancing act, and it means the statements might not be perfectly tailored for any single user's specific needs.
Okay, let's trace the journey of information. A sale happens. How does it get from that initial event all the way to these financial statements? What's the typical flow?
Okay, it usually starts with recording the transaction in a book of original entry, sometimes called a D-book or journal. These are chronological records. So all credit sales might go into the sales day book, all credit purchases into the purchases day book, cash receipts into the cash book, and so on.
Like specialized diaries for different transaction types.
Exactly. It's the first formal recording. Then, the information from these daybooks is posted, transferred to the ledgers.
Ledgers. That's where the accounts live.
Yes. The ledgers contain the individual accounts. You'll typically have a sales ledger containing an account for each credit customer, a purchases ledger, an account for each credit supplier, and the general ledger, or nominal ledger, which holds all the other accounts: assets, liabilities, capital, expenses, revenues.
So the daybooks are the log, and the ledgers are where it gets sorted by account.
That's a good way to think about it. Posting updates the balances in the relevant ledger accounts based on the daybook entries.
And there was mention of control accounts. What are they for?
Yes. Control accounts are summary accounts kept in the general ledger. For example, the sales ledger control account shows the total amount owed by all customers. Its balance should equal the sum of all the individual balances in the sales ledger.
So it's a check.
Exactly. It helps verify the accuracy of the subsidiary ledger postings. If the control account balance doesn't match the sum of the individual accounts, you know there's an error somewhere that needs investigating. Same idea for a purchases ledger control account.
Clever. Like a subtotal check.
Mhm.
And after all this posting,
Before preparing the final statements, accountants usually extract a trial balance. This is simply a list of all the account balances from the general ledger at a specific date, put into two columns: debits and credits.
and the totals of the two calls should.
They should be equal. If the total debits equal the total credits, it confirms the arithmetic accuracy of the double entry bookkeeping up to that point. It doesn't guarantee no errors, but it's a crucial check.
Okay, daybooks, posting double ledgers with control accounts, trial balance, financial statements. That's the flow.
That's the basic flow, yes.
Now, the source material also went into detail on specific transaction types. Cash, credit, returns, discounts, VAT, bad debts, depreciation. Maybe we hit the highlights.
Sure, cash transactions, as mentioned, are often handled in a detailed cash book, which usually tracks bank transactions too. A key process here is bank reconciliation, comparing the cash book records to the bank statement to spot differences like unpresented checks or bank charges.
Reconciling the bank, yeah, always fun. Credit transactions.
Sales on credit create accounts receivable, an asset money owed to you. Purchases on credit create accounts payable, a liability money you owe. Managing these is vital for cash flow.
Returns, if goods come back.
If a customer returns goods, that's returns inwards or sales returns, which reduces your recorded sales. If you return goods to a supplier, that's returns outwards or purchase returns, reducing your purchases cost. They need separate tracking.
Discounts. There are two types mentioned.
Right. Trade discounts are reductions off the list price, maybe for bulk orders. These are usually just deducted before recording the sale. They don't appear in the double entry system itself. The sale is just recorded at the lower price.
Okay, trade discounts are off book, effectively. What about cash discounts?
Cash discounts are offered to encourage quick payment. So if a customer pays early and takes the discount, you record the cash received, the reduction in their debt, and the discount amount as an expense, discounts allowed. If you pay a supplier early and get a discount, it reduces your payment and is recorded as income, discounts received.
Got it. VAT, value-added tax. That seemed complicated.
It can be, but the principle is that the business acts as a tax collector. You charge output VAT on your sales and suffer input VAT on your purchases. Usually you pay the difference to the tax authority, HMRC in the UK.
So it doesn't usually hit your profit.
Correct. The VAT collected isn't your revenue, and the VAT paid isn't your expense unless you can't reclaim it for some reason. The net amount payable or reclaimable sits on the statement of financial position as a liability or asset.
Okay. Bad debts when customers just don't pay.
Unfortunately, it happens. When a specific debt is identified as uncollectible, it needs to be written off. This involves crediting the customer's account, reducing accounts receivable, and debiting a bad debt expense account, which reduces profit.
Ouch.
Businesses also often create an allowance for doubtful debts, an estimate of future potential bad debts based on past experience. This is also an expense.
And finally, depreciation. That's about assets wearing out.
Exactly. Non-current assets like machines or vehicles lose value over time through use or obsolescence. Depreciation is the accounting process of allocating the cost of that asset over its estimated useful life.
How is it calculated?
Common methods are straight line, same amount each year, or reducing balance, a percentage of the remaining value each year. The depreciation amount is recorded as an expense each year in the statement of profit or loss, and it also reduces the asset's value on the statement of financial position via an accumulated depreciation account.
Okay, so all these specific rules feed into the main statements. Looking bigger picture again, what's the ultimate point of all this accounting for managing a business? It's not just history, right?
Absolutely not just history. It's vital for management. The information helps managers plan budgeting, forecasting. It helps them assess performance. Are we hitting targets? Where are we spending too much? It helps them understand their financial position. Can we afford to expand? And it's crucial for internal control, preventing errors and fraud.
And the book mentioned managerial versus financial accounting.
Yeah, briefly, financial accounting focuses on producing those main statements for external users, investors, banks, etc., following strict rules. Management accounting provides more detailed, often more forward-looking, information specifically for internal managers to help them run the business day to day. It's less constrained by formal rules.
So accounting is really the language businesses use to understand themselves and plan their future.
That's a perfect way to sum it up. It provides the data for informed decisions.
Wow, okay. We have covered a lot of ground today, diving deep into the fundamentals from that Frank Wood material. If you had to boil it down, what are the absolute key things you want our listener to take away?
Okay. Number one, accounting is a system. It's organized, it has rules, but it's designed to tell the financial story of a business. Two, the accounting equation, assets, liabilities plus capital, is the absolute core. Everything relates back to it.
Right.
Three, double entry bookkeeping with its debits and credits is the mechanism that makes the system work and keeps it balanced. Four, the main outputs are the financial statements. The profit or loss statement tells you about performance over time, and the financial position statement gives you that snapshot of assets, liabilities, and capital.
And understanding those requires knowing the assumptions, like prudence.
Yes, and remembering that accuracy and clarity in preparing them are non-negotiable.
Yeah, that point about tidiness and accuracy really stuck with me. It's not just about passing exams, it's about real-world reliability. Misleading numbers can lead to terrible decisions.
Couldn't agree more. And look, we've covered the foundations, but accounting gets much more complex. The material just touched on things like different ways to value inventory, FIFO, LIFO, AVCO.
First in, first out, last in, first out.
Yeah.
Those.
Right. Or analyzing financial statements, using ratios to really dig into performance and financial health. There's always more to learn.
So hopefully, this deep dive has given you a really solid starting point and maybe even sparked some curiosity to learn more.
That's the goal. We hope it's demystified some of the basics.
Definitely. So here's a final thought to leave you with. Now that you have a better grasp of this language of business, start looking at companies differently. Whether it's a local shop or a giant corporation, think about their financial activities.
Sure.
If you were trying to understand their success or make a decision about them as a customer, employee, or maybe even investor, what parts of their financial story, their accounting reports, would you find most critical? Considering that might just change how you view the whole business landscape.
Great point. Thanks for joining us on this deep dive.